Welcome again to our Finance Academy online classes. Today we'll talk about the capital asset pricing model. The capital asset pricing model was originally developed or demonstrated by Markowitz portfolio selection model in 1952. In the Markowitz model, an investor usually selects a portfolio at a time period T that produces stochastic return at T. The model assumes investors are risk averse, which means they prefer lesser risk. When choosing among portfolios, they care only about the mean and variance of the one period investment return. Generally, we use the capital asset pricing model in determining the required rate of returns of a company or an asset. An overview of the capital asset pricing model. We have three main inputs of the CAPM, which includes A, the risk-free rate of return, which is estimated as the rate of government treasury bills and bonds, the expected market rate of return, which is estimated as the rate of return received from the securities market, and finally we have the asset beta, which is the variance of the market in respect to a given security. When calculating a CAPM, assets with a lower risk have a lower expected returns, and assets with a higher risk have a higher expected return. How do we calculate the CAPM? The illustration as shown on the presentation gives the formula for calculation of the required rate of return of a security using the capital asset pricing model, taking into account the three factors we have earlier discussed, which includes the risk-free rate, the beta, the return of the market, and the risk minus the risk-free rate, which is equivalent to the equity risk premium. Hence, to calculate the required rate of return of a security, let's take, for example, these financial metrics. Number one, we have an equity risk premium of 0.08, which is also equivalent to 8%, the risk-free rate of 3%, and the first beta we have is 1.25. So, going back to our formula, we can replace with the first equation there, RF plus beta, RM minus RF. If we replace, for the first one we get 13%, and if the beta is lesser, we get 7.8%. It therefore goes in line with the assumption of the CAPM that assets with a lower risk, which is equivalent to beta, have a lower expected returns, and assets with a higher risk have a higher expected return. So, what are the strengths of the CAPM? First, the CAPM is very useful to CFOs or Chief Financial Officers or Finance Managers, and they use it to calculate the beta and also determine the risk of an asset relative to the market. CAPM, secondly, is very important in emphasizing diversification and defining opportunity cost of investors according to the level of risk attached to an asset. CAPM is also a useful model in calculation of the required return of an asset. But what are its limitations? Firstly, CAPM has a lot of assumptions, and based on these assumptions, it is not a useful tool for stock trading or stock selections because of too many assumptions. We might make an error when choosing whether to invest or not invest in an asset. Most of the estimation risk in the beta and market risk premium is mainly for long-term projects rather than for short-term projects. Hence, it becomes vague to use the capital asset pricing model. Thank you for watching this video. To watch more, please like and subscribe on the Finance Academy using our YouTube channel, and we hope to give you more short videos on explaining short finance terms. Thank you so much.